Okay, now that you know how options contracts work, it's time to reveal my strategy for safely and reliably adding income to your account each and every week. But let's first start by noting that options trade on an exchange just like stocks. So you can buy and sell option contracts at varying prices on a daily basis. Each option contract represents 100 shares of stock, so each trade you make will take the price of the option contract and multiply it by 100 shares. You'll hear more about this later on. With that point out of the way, let's start with put contracts. We won't be gambling by buying puts as described earlier. Instead, we'll be selling puts to give the others the option or the right to sell shares to you. The easiest way to understand how my strategy of selling put options works is by using a real estate example once again. Let's assume you're interested in buying a rental house. You want to buy the house at a reasonable price and collect rent from a tenant. You've done your research and found a home in a neighborhood that you really like. The home is being sold for $120,000. Now, $120,000 may be a fair price for the home, but it's more than you really want to pay. You know the house has been on the market for a while, so the seller may be getting impatient. So you knock on his door and make him an offer to buy it for $100,000. The seller thinks the price is too far below the $120,000 listing price. But he also tells you that he may be willing to sell it to you for $100,000 later in the year if it doesn't sell. Now that doesn't work for you. You might want to buy another house if one becomes available in the interim. So you come up with an idea. You propose that the seller pay you $5,000 today to secure your offer. So for $5,000, you would be willing to wait to buy his house at $100,000. If the seller decides that he wants to sell the house to you at $100,000 at a later date, you get a great deal, and you get to keep the $5,000. If the seller finds another buyer for the house at $120,000, you still win. You receive $5,000 for waiting to see if the seller would sell it to you. That's the same strategy we use for put options. Instead of making an offer to buy a home at a cheaper price, we're making an offer to buy a stock at a cheaper price. By selling a put contract, we're giving an investor the right to sell stock to us at a specific price. And the investor pays us for that right. The key to this strategy is to find a stock that you're willing to own and then to sell a put contract that pays you to make an offer to buy the stock at a price that you're comfortable owning it at. Here's how it works. Let's say that you're interested in buying an airline stock because lower oil prices have lowered its cost and boosted its profit. The stock trades at $27. You're happy to buy it as low as $25 if it traded down. You could sell a 3-month put option to give another investor the right to sell the stock to you at $25. When you sell that put contract, you get paid to accept a 3-month obligation to buy the airline stock at $25. How much you will get paid depends on what the put option contract is priced at when you sell it. In this example, let's say you're paid $1.50 per share or $150 for every put contract that you sell. The beauty of this strategy is that you're getting paid income to own a stock that you're already interested in owning at a price that you're willing to pay for it. Once you sell the put contract, there are 2 things that can happen. If the airline stock stays above the $25 contract price, the contract will expire and disappear from your account. After all, why would the other investor sell stock to you at $25 if he can get a higher price in the market? And since you sold the put contract, you get to keep the money that you received from selling this option contract. No strings attached. You can now decide to sell another put contract on this airline stock. Or you can sell another put contract on a different stock that you want to buy. Now here's the second potential outcome for this trade. If the stock that you're interested in buying at $25 trades lower over the course of the contract, say to $24 per share, The owner of the put contract would have an incentive to sell you the shares at the higher price of 25. That means you're obligated to buy 100 shares at 25, even though the stock is only priced at 24. Now, at first blush, it looks like you're getting a bad deal. But remember two critical things. First, you wanted to buy the stock at 25. If you believe in the prospects of the airline, then you should expect its shares to eventually trade higher. Second, you received $1.50 per share, or $150 per contract, when you sold the put. So even though the stock is trading $1 below where you were obligated to buy it, you're still ahead. The income that you receive from selling the put is greater than the $1 per share that you were down on the stock. The income you receive from selling the contract helps offset any decline in the stock price. Now think about how this strategy compares to a traditional buy and hold strategy. If you bought the airline stock the same time that you sold the put contract, you would have paid $27 per share. Now when the stock dropped to 24, you'd be nursing a loss of $3 per share. But with our income approach, you'd actually be up 50 cents per share on the trade, even though the stock moved lower. Now you may be asking, what happens now with the airline stock that has been put to us? Is there a way to generate income from these shares? Yes. And that's the next topic I'm going to cover in our next video.